The Medtronic PLC stock is currently trading at $101.95, representing a strong intraday gain of 5.84% today as of 11:40 p.m. IST, which is a couple of hours into the U.S. market day given the time difference. This sharp move upward, pushing the price near its 52-week high, immediately challenges the common market narrative of Medtronic as the slow-moving, reliable, but essentially low-growth stalwart of the medical device space. The expectation for a giant like Medtronic is usually slow, steady accumulation, maybe a percentage point or two on a good news day, but a nearly 6% spike is a massive acceleration, forcing investors to reevaluate the company's growth trajectory. This isn't the behavior of a stock merely coasting on its dividend aristocracy. This is a stock reacting to a profound, fundamental shift in its business outlook. What's driving this is a reality far more compelling than general market sentiment: the spectacular outperformance in its cardiac ablation solutions portfolio, specifically the adoption of its pulsed field ablation or PFA technology. The general belief has always been that Medtronic is the stable, diversified behemoth with a mature portfolio, a classic hold in many Fidelity or Schwab Intelligent portfolios. Investors look at the overall size of the medical surgical segment and see a low single-digit organic growth rate, and that anchors their expectation for the entire company. But the truth is that, under the surface, specific segments are experiencing genuinely explosive growth, and the latest earnings report, which drove today's price action, has finally made that reality undeniable. In their second fiscal quarter for 2026, Medtronic not only beat analyst consensus on both adjusted earnings per share, EPS of $1.36 versus $1.31 expected, and revenue, $9 billion versus $8.87 billion expected. But they also raised their full-year guidance for both organic revenue growth and adjusted EPS. The market's reaction today is a direct acknowledgement that the company is moving past its years of perceived stagnation, and this momentum is driven by a few key high-growth products. The 71% year-over-year growth in cardiac ablation solutions revenue and the astounding 128% growth in the U.S. alone for that segment is what has captured the market's imagination. This is not incremental improvement, it is market share conquest in a high-value, fast-growing procedure category, a truly stunning figure for a company of Medtronic's size. The institutional activity surrounding Medtronic has been mixed, which perfectly illustrates the tension between expectation and reality that we're talking about. Filings show some institutional investors, like Dorsey & Whitney Trust Co., LLC, reducing their position in the second quarter, likely based on that old slow-growth narrative. Yet other funds, such as Nomura Asset Management Co. Limited and Raiffeisen Bank International AG, have been significantly increasing their stakes. This divergence in institutional activity shows that the smart money itself is split between the long-term, slow-growth view and the more aggressive view that the PFA story and other key product launches are fundamentally changing the return profile. For the individual brokerage user, whether you are utilizing Robinhood stock trading for its simplicity or an interactive brokers trading platform for its advanced tools, understanding this underlying battle of narratives is crucial. Are you basing your investment decision on the diversified old-school Medtronic or the lean, innovation-fueled Medtronic that's emerging in the cardiac and hypertension spaces? The high trading volume today suggests a massive amount of capital is pouring into the stock to back the latter viewpoint, essentially repricing the company for a higher growth multiple. This level of interest, where institutions are fighting over the narrative, is exactly what gives a seemingly stable stock its current volatility and upside. Shifting focus back to the core business, Medtronic is the largest pure-play medical device company in the world. Their business model is built on four main segments: cardiovascular, medical surgical, neuroscience, and diabetes. The cardiovascular portfolio, which includes cardiac rhythm and heart failure, structural heart and aortic, and coronary and peripheral vascular, is the star of the show right now. The company's long history is littered with essential medical firsts, from the first wearable pacemaker to the first MRI-compatible pacing system. The sheer breadth of their product offerings means they are indispensable to hospitals and surgeons globally, which historically has given them incredible pricing power and stability. This stability is why they are a dividend aristocrat, having raised their dividend for 48 consecutive years, a powerful signal of financial resilience that appeals to conservative investors looking for online investing stability through platforms like SoFi Invest. However, this stability often masked slow organic growth in recent years, making the stock a laggard compared to more aggressive growth stocks like Nvidia or high-flying tech names. The medical surgical segment, for example, which includes surgical and endoscopic tools, saw a modest organic growth of around 2.1%, showing that the slow growth segments are still there, but they are now being eclipsed by the high-growth products. This is the reality check. The slow parts of the business are still slow, but the fast parts are now truly fast, and that's changing the overall company average. The recent operational performance provides compelling evidence that the management's focus on enterprise-wide growth drivers is paying off. They are deliberately prioritizing investments in specific, high-potential areas. Beyond cardiac ablation, the company's Simplicity procedure for uncontrolled hypertension and the Hugo robotic-assisted surgery system are the next major drivers. The Simplicity system, which uses renal denervation to treat high blood pressure, recently received favorable coverage determinations, which is a regulatory and commercial hurdle that immediately expands the addressable market dramatically. Furthermore, the Hugo robotic surgery system, while playing catch-up to the market leader, is a crucial long-term play, and any positive news regarding its approval and adoption in key markets like the US will serve as a massive catalyst. These two areas are essentially Medtronic's pipeline for sustainable, multi-year, mid to high single-digit revenue growth across the company, supplementing the already soaring cardiac ablation results. This strategic shift from trying to drive marginal gains across thousands of products to focusing on a handful of products that can deliver exponential growth is the fundamental change in the Medtronic investment thesis. This kind of nuanced analysis is what differentiates informed self-investing from simply clicking a buy button on the Robinhood app or a Fidelity mobile app. It's about understanding where the company is allocating its resources for future returns. Let's look more closely at the diabetes business. This segment, which includes insulin pumps and continuous glucose monitoring devices, has been a source of both frustration and potential. It reported strong organic growth of over 7%, driven by the continued rollout of its latest insulin pump system. The noise around this segment is the possibility of a partial spin-off. While the company has been clear that a separation is not imminent, management has actively discussed options for this business. Such a move is generally viewed favorably by the market, as it would likely simplify Medtronic's overall structure, allow the core business to focus on its higher-margin medical, surgical, and cardiovascular lines, and potentially unlock greater value for the standalone diabetes unit. The market often discounts a conglomerate's valuation because of its complexity. A potential spin-off would address this, proving yet another strategic lever the company can pull to improve shareholder value irrespective of the current growth drivers. This, combined with the fact that approximately 82% of the Medtronic stock is held by institutional investors, emphasizes that major capital managers see the underlying value even if they sometimes disagree on the timing and speed of its unlocking. The macroeconomic environment is, for the most part, a tailwind right now. The medical device industry is benefiting from a continuing global rebound in elective procedures that were delayed during the pandemic. Hospitals are operating at higher capacity, and the backlog of surgeries that require Medtronic's devices, from pacemakers to stents to surgical tools, is still being worked through. This procedural volume rebound is giving the company a solid base to its organic growth. However, there are two primary pressures: foreign exchange fluctuations, given that foreign sales account for almost 50% of the company's total revenue, and the persistent challenge of supply chain and labor costs. Medtronic's improved gross margin in the last quarter suggests they are successfully navigating the cost inflation headwinds, showcasing good operational execution. They are managing to turn the robust procedure volumes and the higher margin PFA sales into leveraged earnings, which is a positive sign for profitability moving forward. For anyone conducting their own research on investing sites or using intelligent portfolio software, observing the gross margin trend is essential, as it's a pure measure of a company's operational efficiency in a high-cost environment. Looking forward, the future outlook for Medtronic is centered entirely on the continued execution of its growth drivers. The company's raised guidance suggests management has high confidence in the second half of their fiscal year. The cardiac ablation momentum is expected to continue, especially as pulsed field ablation, a superior, faster, and safer way to treat atrial fibrillation,